Hello friends, this is Dr. Matthew Ademola, your instructor for the course. How are you? This lecture focuses on the role of financial markets. And the financial markets are the markets where investment vehicles, bond stocks are sold. You have short-term investments and you have long-term investments. Financial markets actually play a very important role in the entire financial industry. Financial markets are places where people meet, corporations come together, and institutions come together either to lend money, borrow, or invest money. Well, that is simplistic, but it's much more complex than that. You have a lot happening in the financial market. Participants can be national, state, and local governments also. They also participate in financial markets. For example, local municipalities sell bonds to people as long-term investments. Those bonds are long-term financial obligations on the books of the local governments. The markets are public financial markets. You have also corporations all the time. They sell shares of stock to people to raise funds for different kinds of investments. They may be trying to have an R&D in a pharmaceutical company, for example. That pharmaceutical company may need some money to begin some research and development, and it will need some money from the public to finance such projects. In some cases, a technology company, a tech company may be interested in raising funds for the purpose of revamping its technology. A manufacturer of automobile may also be looking for funds to manufacture automobile. So all these are different ways, all these are different reasons why corporations participate in raising funds and they go to the financial market. They can either sell bonds, which is long-term obligations, or they sell shares, which is speculative. And of course, shares, when sold, the owners or the buyers are considered owners of the corporation. So that is very important to remember. The structure and functions of the financial markets. It is very important that you have an understanding of the distinct parts of the financial markets. By having a solid understanding of the concepts or the conceptual framework of these different parts of financial markets, you will have a better understanding of the markets themselves, the individual markets themselves. We have the domestic and international market, all right? And when you compare the domestic and international markets, you notice that there are major differences, particularly when you interact internationally. You have to deal with cultural nuances, situations having to do with the culture, the different economic system, political systems, all these have to be addressed when you are interacting internationally. We also have corporate and government markets. Corporations raise funds, so do governments. Governments need money for major projects, building a bridge or providing infrastructure for a given locality. It could be state, it could be local area, it could be federal. The government may have to sell bonds to raise such funds. And then you have the money and capital market. Okay, money market is short-term investments and capital markets are long-term investments. We're going to see the distinction in a minute. All right, money markets deal with short-term securities with life of 1 year or less. Exactly what I said. And examples of money markets are commercial paper sold by corporations to finance daily operations, and also CDs, certificate of deposits, that mature within a year or even less. So sometimes you buy CDs from banks, a 60-day CD, 90-day CD. When it expires, then you can renew the CD. It's rolled over. You can roll it over. The interest will accumulate over time. And of course, there are different rules regarding penalties regarding early withdrawal. Capital markets deal with securities that have life or more than 1 year. Long-term markets, long-term investments are considered to be capital markets. They define as either 1 to 10 years, which is intermediate, and of course, if it's longer than 10 years, it is considered long-term markets. For example, you may have a government issuing bonds that will be paid back in 30 years. It means the bonds will mature 30 years from now. So that will be long-term investment because it's a long-term financial obligation on the books of the government. If it's a corporation, it's a long-term financial obligation on the books of the corporation. So securities include common stock, preferred stock, and corporate and government bonds. So when we say securities, anytime we talk about securities, we are referring to common stocks, preferred stock, and corporate and government bonds. As we continue this course, you will begin to understand the distinctions between these three kinds of securities. Just for now, common stocks are most speculative, all right, followed by the preferred stock, and then followed by corporate and government bonds. Government bonds are very secure, so the coupon rate, which is the return on investment on government bonds, are very, very low because government bonds are very little risk. So you have to understand that there is a relationship between risk and return in finance. The higher the risk, the higher the return. So government bonds are less risky than corporate bonds because 9 times out of 10 or 9.9 times out of 10, the government will not go bankrupt and payability is not in question. In the case of corporate bonds, corporations can fold up, they can go bankrupt, making the bonds useless in some cases, or even common stock or preferred stock. As we go ahead in this course, you have a better understanding of the relationship in terms of financing between these securities. And you understand better why some people will prefer common stock as to corporate and government bonds. But for now, the reason why people will prefer common stock is because they're looking for long-term equity, long-term investments, and that they believe that the company will maximize their wealth. So in chapter 2, and even in this chapter, we will talk about shareholder maximization. Allocation of capital. In the primary market, when corporation uses financial markets to raise funds, all right, sales of securities made through new issue is called IPO. So the primary market is the very first time, that is the market in which the very first time a security is sold. For example, say ABC Corporation needs some money to finance research and development. So ABC, say, is a tech company or is a pharmaceutical company. So it's going to issue the initial public offering, which means the very first time the company actually sells bonds to the public, so that people will give money to raise money for the venture, for the program. And it could be a situation whereby the company would like to have a mix of bonds and stocks, which is called capital structure. In other words, the capital structure, you're going to come across that definition as we go ahead, is the combination of equity and debt. In other words, shares of stock we've considered equity because buyers of shares of stock are considered to be equity owners. They own part of the corporation. And buyers of bonds are considered to be creditors. They actually loan money to the corporation. So anytime we talk about capital structure, we are simply talking about the combination of debt and equity, shares of stock and bonds. Again, shares are most speculative, and the bonds, of course, are long-term investments. The secondary market is like any secondary market, like a secondary market for cars, would be second-hand cars. So when the securities are bought or sold the second time, let us say Mr. Smith buys ABC Incorporation bonds and then takes a look at the bonds, and after 5 years, he says, I'm not going to wait until this bond is redeemed. Maybe it's going to redeem 20 years from now. So let me just sell the bond. All right. It could be shares also. So price of securities keep changing from time to time. Yes, based on a number of factors. And as we continue in this course, you will know the reasons why prices of securities change over time. All right. For the most part, it has to do with the performance of the market, the economy, the micro and macroeconomic factors impact price of securities. Financial managers have the responsibility of giving feedback about their firm's performance. That is why at the end of the year, shareholders meetings are held, and the CFO is charged with the responsibility of explaining some facts in the financial statements and answering questions from investors regarding the firm's performance. Allocation of capital continued. Return maximization and risk minimization. The primary goal of financial manager is to maximize the return on investments of investors and minimize the risk. Investors can choose between risk level that meets the objective, maximizes return given risk level. In other words, once you have determined that you want a certain level of return, you have to accept the associated risk, because the higher the risk, the higher the return. So the relationship between risk and return in finance is a relationship of direct proportionality. In other words, they go the same direction. When the risk goes up, return goes up. When risk reduces, the risk of the investment reduces, return also reduces. I'd like to emphasize that risk in finance does not necessarily mean that you should not engage in investment. When investment is said to be risky or has a risk level in finance, it does not necessarily mean you should not invest. It simply means that there is a likelihood that the return you're expecting may not be exactly what you're looking for. In other words, risk is called variability of returns, the extent to which the return on your investment will vary. For example, let us say you have invested in shares of a corporation and you are told that the annual rate of growth is 6%. So there is a likelihood that you may get a little less than 6 or a little more than 6. So that is what we call risk in finance. It does not mean that the business or the investment is not worth your while. And of course, every risk level does come with some amount of return. So what is important is you as an investor have to take a second look at yourself and say, do I want this level of risk? Am I risk averse? That means, do I want to stay away from risky investments, investments that have high risk, or am I risk neutral? Or am I conservative? That simply means I'm ready to take some degree of risk for some degree of return. Most investors, of course, they are risk averse. Firms pay penalty for failing to perform competitively. It simply means if firms do not meet the standards expected of the investors, chances are the investors will withdraw their funds by selling the investments that they have with the companies. In international finance, we call it capital flight. Capital flight. In other words, the investors will take their money from that country and that's very corporation and go elsewhere. So this is the lecture for this section of the book. So I will see you next lecture in week 2. Thank you so much for your time.